What if I told you that the most powerful asset in the global economy doesn't even appear on a financial statement? Most creators are sitting on a gold mine of intangible equity that traditional depreciation models simply just cannot comprehend. Today, we are dissecting why the old rules of finance are failing and how your personal brand has become the ultimate infinite scale machine. A company can spend $10 million on equipment, and it shows up on the balance sheet. A creator can spend 10 years building trust, attention, and an audience. And on the balance sheet, almost nothing. That's the concrete fallacy. That's what we're talking about today. We still treat physical assets as the real assets. But in the digital economy, some of the most valuable assets are the things accounting barely measures. Attention, trust, distribution. And that creates a massive gap between what a business is worth on paper and what it's actually worth in the market. Traditional accounting was built for a world where business value is easier to see. A railroad owned railroad tracks. A manufacturer owned machines. A retailer owned inventory. If the company bought something physical, it could usually be counted as an asset. But if a company spent money building a brand, an audience, or a community, it usually gets treated as an expense. And that difference matters. Because an asset says, this creates future value. An expense says, this costs money, and now it's gone. Now, a quick side note before we continue. Accounting can measure bought intangibles, patents, trademarks, brand identity, things like that. But the creator economy is built on earned intangibles, internally built intangibles. And that's where the balance sheet starts to go a little blind. It struggles with the thing that makes a creator powerful, the audience that trusts them before the product even exists. A personal brand can do three extremely valuable things. First, it can lower customer acquisition costs. 2, it can create pricing power. And 3, it can launch products without starting from zero. That's not soft value. That's business value, and that's something a lot of businesses wish that they could have. A company with no audience has to rent attention. It buys ads, it pays for influencers, it pays platforms. A creator with a loyal audience already has a direct path to the exact market they're serving. Not perfect ownership, of course. The platform can change, the algorithm can shift, the audience can leave. But economically, the relationship still has value. If 100,000 people consistently listen when someone talks, that's not nothing. But most of that value never appears as an asset. The laptop might, your camera might, the desk might, but the trust that makes the whole business work, that can be invisible. This is how you get the valuation gap. On one side, you have traditional companies with large physical footprints, stores, warehouses, equipment. They look valuable because they own lots of stuff. On the other side, you have lean personal brands, a creator, maybe a small team, a loyal audience. They may not own much on paper, but they can move attention faster than companies with 10 times the overhead. And that's where we go back to the concrete fallacy, is the belief that the most valuable parts of a business must be physical. They have to be owned and they have to be easy to measure. But modern value doesn't always look like that. Sometimes the most valuable asset isn't the building, it's the audience. Sometimes it isn't the equipment, it's the trust. It's not the inventory, it's the demand. This doesn't mean personal brands are risk-free, however. They're absolutely risky. Audience can fade, platforms can change, trust can disappear overnight. That's why accounting struggles with this. It doesn't want to guess. It doesn't want to inflate value. It doesn't want to put vibes on a balance sheet and call it an asset. And honestly, that caution does make some sense. But hard to measure doesn't mean it's worthless. It just means the value is harder to see. The old asset stack was physical. Land, buildings, machines. The new asset stack is digital, audience, trust, distribution. The old question was, what does this company own? The new question can be, who can this company reach? Because reach changes everything. It lowers marketing costs, it speeds up product testing, it creates pricing power. That's why a personal brand can look tiny on a balance sheet and still be extremely valuable in the real world. The value isn't sitting in a warehouse. It's sitting in the relationship between the creator and the audience. So when people say personal brands aren't real businesses, they're usually thinking in concrete terms. Where's your building? What equipment do you have? No inventory? But the better questions are, where's the attention? Where's the trust? Where's the demand? Because in today's economy, the company with the most stuff doesn't always win. Sometimes the winner is the person with the strongest relationship to the market, the most direct link to the market. And that relationship may never show up on a balance sheet, but it can still be the most valuable thing the business has.